Are live. Hey guys, how are you guys all doing?
Hey, hey.
We got Mark and Charles here again, and we have a special guest who may hopefully become a more regular guest. We have Dr. V is kind of how I call you, Dr.
Okay.
V. I'm sure Why don't I before we get started? Why don't I give a second, to introduce yourself?
Yeah, sure. Quite literally, take a couple of seconds. Thanks for having me on here, Charles. Nice to meet you, Mark. Again, my name is Dr.
I'm
My name is
sure.
Venetia. My name is Venetia Dutra, and most call me Dr. V. And I'm a finance professor and have been so for a long time. I study all things markets, volatility, investor behavior, investor psychology, these types of things. And more recently, I've spent a lot of time in the policy and regulatory space. And that's sort of what my relationship is with respect to cryptocurrency, looking at the regulation and the policies that are coming down the pike and how that may and ultimately will, not may, how that will transform this space and what that means to investors. So that's me.
Cool. Well, speaking of everything, SEC regulation and everything, it seems like more and more mainstream is looking at crypto, and not just mainstream, but, smart money, right? Wall Street is looking at things. And maybe, Mark, you might want to bring this up. I saw there was a recent thing by Goldman Sachs talking about how, this crypto stuff is legit or somewhat, it's not a scam, right? We had a big event last week where Jamie
Diamond.
Dimon, I think that's how I
Diamond.
pronounce his name. Basically, the Chase, yeah, Jamie had said, well, I kind of changed my mind. I feel bad about saying Bitcoin was a bad thing. I think it's a good thing now.
Well, that
Maybe
comment
Mark, do you
was
want to take a
more.
second and kind of,
Yeah,
or you can go ahead, Dr. V. Go
No,
for
no,
it.
no. Go ahead. You asked Mark. Go ahead. Go for it.
I was just going to start off by just throwing out this statement that I think can frame a lot of what we're talking about. Um, it doesn't matter what market you're in or what you're doing. When there's money to be made, scammers come out. Plain and simple. So it doesn't matter if you have the best, life-saving drug in the world, scammers are going to come out. It doesn't matter if you have the best solution for the world's money problem, scammers are going to come out. So, it doesn't matter what you're doing, they'll be there if there's money involved. But I think it's important to look through, that more than just a thin layer to be able to separate, the real from the bad. And so, obviously something as massive as this, there's gonna be scams out there, but I don't think that you need to taint the whole industry over that. So I think that's just a good statement to make, over the whole thing itself. And so you started off by Jamie Dimon saying that, and again, that's such a general statement that I just think it's just way too general to be made like that.
Which statement, Mark? One
Oh,
he
that
initially
that
made.
that it's a scam, that it's a scam, that it's a fraud, things like that, So I just think that's a very general statement. So
Very much so. Yeah.
what's that?
I say, yeah, very much so. That was very broad.
And even just cryptocurrencies in general, like, oh, cryptocurrencies are, you know whatever people want to say about them, they're so different that you just really can't stereotype them, I think, with one statement. um, there's definitely bad characters in the space for sure. There's horrible projects. There's people getting in that don't know what they're doing, that are pushing the market higher and
Right.
setting themselves up for very bad problems. But there's also
Right.
people in parts of the world that are really in need of a solution like this, and they're finally getting a solution for that. And we're also seeing cutting edge technology that's going to drive the future for the world. So we have kind of the whole range of spectrum in there.
Yeah, and Charles, to your point, so when Diamond came out and sort of retraced his steps or retraced his statement, he's really talking about the blockchain technology being a significant player in the future. When I look back at what he said, he is actually even adopting the blockchain. Many banks, many mainstream commercial banks, I teach about this stuff every day, are now adopting or see the future in this blockchain space. And that's one of the things. So I don't look at it only from a cryptocurrency standpoint. I do a lot in the real estate space. So a conversation I had with some real estate professionals and attorneys last week was really how the blockchain might transform how we see real estate, how we look at real estate, and how real estate transactions happen in the future. I mean, the ability to connect people and verify things electronically, quickly, and have checkers in that space could get rid of title company. I mean, totally wipe out title companies as we know it. You know, the transaction costs associated with a real estate transaction is significant. I mean, it can totally transform what we do, how we deal with realtors. I mean, I think the blockchain is what he's retracting on. If you've listened to statements he's made in the public, I mean, that's what the belief is in. I think, as Mark just mentioned, there are a lot of scammers in the space. There are a lot of people jumping on the bandwagon. I mean, I just started teaching this quarter. We're on a quarter system at my university. And one of the things we talked about the first week was how a number of companies in the past year that were failing, absolutely terrible products, horrendous service, no cash flow to speak of, in the red, changed their name, didn't change any of their operations, simply changed their name from ABC Pharma. I won't mention the names. You can Google it. It's all there. ABC Pharma to Riot Blockchain, and their returns overnight.
I was laughing about that.
That 1,000%, man. I mean, this speaks to the hysteria and mania in this space. And when I talk to investors, that's what I try to safeguard against, understanding exactly what this thing is, what phase we're in, what you are investing in. Because as Mark said, there are some companies that actually have a decent product. They're attempting to do something decent. But there are a lot that have just jumped in this space because they understand that there are a lot of naive investors in this space that and we've seen this before, right? We've seen this before, that are just jumping in, and these returns are skyrocketing. It's mind-boggling.
It's funny that you bring up Bioptics. Yeah, they're definitely an interesting one. But I think maybe, why don't you talk about it? I know you had mentioned you just had a meeting with the Denver or the Colorado.
No, the Colorado. Yeah. So again, I think it's very short-sighted, and we see a lot of this. I think it's very short-sighted to look at the cryptocurrency space from a return standpoint. I think it's foolish, to be quite honest. Again, because markets are dynamic, and because many people don't really understand the asymmetry with returns in the market, right? So if you talk to any really informed investor or someone who has been trading money or managing money for decades, they'll tell you that the way to make money in the market is to not lose it. I mean, period. We are risk averse beings, and we can talk about the version, but the way to make money is to not lose it, because returns are asymmetric, right? So if you start with $100, the market goes down 50%, you know what you're down to, $50. But if that market goes back another 50%, you're not back at your initial investment, right? So you have to really understand the whole landscape. You have to educate around the whole investment environment. We don't see a lot of that. We see people on YouTube with videos barely with a high school diploma, you know, with cars, walking out of their garage and with, you know, with 6 Maseratis behind them and some huge mansion in the hills that undoubtedly they rented, you know. There's a huge marketing machine behind this thing. And it's—
So are you referring to the other guy out of LA who has been
I'm not saying it. Wait a
program?
I'm not saying any. No, but Charles, come on. There are tons of them. I mean, I can't go on Facebook. I'm like going to boycott Facebook at some point. It just boils my blood, you know, when you see, and because so many people buy it. You know, I call it the catch-up syndrome. You know, people feel like they have been disenfranchised or left out of the equity markets, or it hasn't worked for them. And so they see this market as a way to catch up. Right. So I call it the catch-up market. It's the catch-up syndrome. I'm actually writing a paper in this space right now. It's a little white paper. But you have to be really careful. But anyway, back to your original question, because I can go on for days, you know, just ask my students, they'll tell you. So yeah, I just had a meeting with some policymakers, some really sharp people. Not quite sure how I got invited to the table, but so it was the Colorado Securities Commissioner. He sort of headlined it, Mr. Rome, just a super, super, super sharp guy. And obviously at the forefront of what's happening in the regulation space. And like I said, we didn't talk about returns. We talked about the policy and the regulation coming down the pipe in this space and how that's going to transform this space. And I think the overwhelming, it was unanimous. We all know it's here and it's coming, but we just sort of discussed why and sort of disagreed. The discussion was around how soon and what this industry will look like. And not even in 5, 10, 20 years, but in a year. Okay. So, and a very interesting conversation there.
Well, would you be willing to share some of the more details of that?
Yeah, I mean, so I can share some. Some.
Yeah,
I'm
I mean,
not
obviously
sure.
there's confidentiality.
Basically, yeah. So I have to be careful. But regulation is here. Regulation is coming. I think there's a lot of resource and money going into. You know how government is. Government is always behind the ball. They're always trying to catch up. You know, it's like the market has gone, things are happening, and the government's like, oh crap, you know, we probably need to pay attention to this. And then they start getting, you know, the government has the power to throw out big money to get the right people in the room to figure out whatever they need to get figured out. And that's what's happening. And these people are working, you know, 24/7 to figure out how to stay on top of this. You know, so what is the SEC created for? Why is the SEC in place? It's in place to protect the everyday investor. And so the same returns that are touted in front of investors that sort of pull the naive investor, or pull everybody, not just the naive investor, but pulls the investor in and catches their attention, will be the same returns that will wipe them out, that will wipe the majority of them out at some point. And I think the question in that meeting was not if, but when, and what will be the ramifications of that? What will the government have to then step in and do if nothing happens in this space and you have a significant amount of wealth just wiped off the face of the earth? And what the government's role will have to be in coming in behind that to clean that up. You know, as you see people who are using their paychecks to go into cryptocurrency that are you know, liquidating 401ks and retirement accounts to go.
The thing that I just see on this though is, like, you know, Jamie Dimon came out and told us it was a scam, it was a fraud. You know, he'd fire anybody. This was a couple months ago.
Right.
But my point is that if the SEC, the government, the bankers, whatever you want to call them. I mean, Jamie Dimon, JP Morgan is the head of the Fed Bank. If they really cared about the average public so much, like they want us to believe, then where were they warning us in 2008 when they had done almost $1 quadrillion of derivatives that bankrupt the entire world? So you're talking about the average mom and pop losing a paycheck. they bankrupt the entire banking system for the entire world, and nobody was coming out warning us then, like for the public's benefit. So I think a lot of times you have to like look at information that you receive and look at, who it's coming from, and
Absolutely.
and the motives that it's there for. And again, I set the blanket statement to say that sure, there's scammers in this space like anywhere else, and people need to be cautious for sure. But it just, the thing that I can't get past is that, well, and really the entire industry was started because of one thing. So the cypherpunks, Satoshi Nakamoto, a group, whatever, they created Bitcoin in a direct response to the banking collapse of 2008.
That's
2009.
right.
And they understood that when we got off the gold standard, or in any country, go back to Rome, when they start to devalue their currency, what happens to that civilization? And so we can study it through history over and over. And so when we left a found money system in the 70s, we started getting all these problems, and now you have these derivative markets. And so just to put things into like a little bit of perspective, for those of you that don't know, I mean, derivatives, and you can correct me if I'm wrong, this may be too simplistic of a view, but derivatives markets are basically bets against a market. So if I want to do derivatives against Bitcoin, I don't own Bitcoin. I'm just betting whether it's going up or going down.
Well, I mean, there are multiple ways. I mean, you can use the derivative market to hedge or as a speculative instrument, right? So it depends on how you use it.
But you're not actually owning the asset. You're hedging or speculating against the asset.
You can have you can cover something that's naked, or you can be long that asset. So it just depends.
Yeah, you can, but most of the time it's naked. And the reason why is because right now the derivatives market, well, as of a couple of months ago, was estimated to be somewhere between 600 trillion up to 1.2 quadrillion. They don't even really know. So that was
leverage, right? And that's what derivative markets allow you to do. They allow you to leverage. I mean, that's
so they've leveraged 1.2 quadrillion dollars globally, but there's not even that much money. There's not even not even a drop of that money. As a matter of fact, like, let me just share my screen and we'll just look at this real quick so we can kind of put this into perspective a little bit. Or I don't know if I'm going off track here, Charles.
Do you want to go for it?
That's all good. No, let's do it.
This is a great conversation.
So let me just zoom in a little bit here. So just to put things in perspective, each square is worth $100 billion.
Mm-hmm.
So this is silver right here. This is $100 billion market for silver. We have cryptocurrencies right here. These are the biggest companies in the United States. This is just the United States. This isn't the world. Look how small cryptocurrency is just compared to the companies. Look at the 50 richest people, California's GDP, the Fed's balance sheet. This is the currency of the entire world. So when I said the derivatives is 1.2 quadrillion, the money supply is about 7.6 trillion. And then you have 1.2 quadrillion bets against a 7.6 trillion currency. I mean, how does that even make sense, right? Then you have gold. So gold's about 8 trillion. You have all the stock markets of the world. Here's the global money supply. So look at this. It's pretty big, obviously. Now remember, cryptos was just two of these little squares. So here's the global money supply. Now look at the debt. Look at this debt right here. Look how far this goes. And it keeps going. Now, if you think that's big, here's real estate. And just hang on here. Okay, look how big real estate is. This is the debt and real estate. Now, look at this. You want to see derivatives? This is the low end estimate, is what they say. This is for 540 trillion, not the 1.2 quadrillion. Look how long this keeps going for.
It's still going.
Yeah.
Look, it keeps going.
Yep.
Look, it keeps going. Keep going. Keep scrolling. There we go. And here's Bitcoin over here, one square. So I just have to think, is there bad actors? Yes. Are people getting in that are unaware of what they're doing? Yes. And we talk regularly that I believe 95% of these blockchain companies will be out of business. And I think it's going to happen. And so it's dangerous. I guess my point is that if these regulators and these banksters are so concerned about the public,
Mhm.
look what they're doing.
Mhm.
I mean,
No, listen, I follow
and
your point.
where are they warning us? And so when I look at them, when I look at the media and they're saying they want to protect us, they want to protect us, they want to protect us, it just seems a little far-fetched, I guess.
No, listen, I understand your point. The point taken. If we look at history, and we know that government tends to be very reactive, and we know that where there is power and money, the powers that be want to concentrate that. So the SEC, again, this is a longer conversation, and I probably should be careful what I say. Actually, I will be careful what I say because of the people that I'm around all the time. But I'll say this. You're right. Is the SEC perfect? Absolutely not. And I am not here to be a proponent of government intervention. I'm not here to be a proponent of anything. I'm here speaking what I have seen and what I know to be coming. I think the bigger issue, you mentioned two things. You mentioned the size of Bitcoin relative to all these other asset classes or in the level of debt. One, I think you have to be careful to describe things in terms of size of something else. Because it is smaller or larger, still does not really get to the heart of the question. And that is whether, regardless of whether it's a small market or a good market, it doesn't answer whether it's a good market or a bad market. So size in and of itself, to me, is not a motivator, is not really telling me anything. I think what you have to ask is, again, if you agree that 90-something% of these players won't be around, the question is how much money gets wiped out, not relative to something else, but just stay where we are. How much money gets wiped out for all of these people that have been putting money in it, with 90-something% of the players disappear, sort of like the internet situation we saw, right?
Exactly like it.
We're putting .com, and then valuations were through the roof. Now, how do we value those companies? I mean, that was a huge conversation we had back then. Well, how are we coming up with these valuations, and nobody knew? And so at the end of the day, what I teach in my classes, what we teach every day, is that you have to understand the vehicle in which you are investing in, period. If you don't understand it, you better move cautiously. And I just don't see that in this space. One, there's a lot of misinformation. There are a lot of people with, you hit the nail on the head, Mark, in my opinion. There are a lot of people where you need to question their motive. You really need to question their motive. And you have people that are trying to inform, and you have people that are jumping in to make a quick buck. And that's small players and large players. Like I said, you have to be careful and understand that when people are changing their name and they're not in this space at all. I mean, Long Island iced tea, really?
Kodak.
Really?
Like Kodak?
Like Kodak. I mean, I didn't even know Kodak still existed. I remember my 110 back in the day, and I was like excited about life when I had that.
Well, there's also Hooters blockchain too. I don't know if you heard about that.
Right. Well, yeah, I guess you guys were. But yeah, exactly. But you have to be cautious when you see these people playing off of this, because Mark is right. You have to look at history to see where we're going. And we have seen this before. So again, do I believe in the technology behind this whole vehicle, this whole space? I absolutely do. And I don't really speak about it, to be quite honest, from the cryptocurrency standpoint. I see this thing transforming how we do transact. I mean, that was a big part of our conversation, last week. I see the blockchain transforming how we conduct services, how we provide, how transforming a lot of industries. And I think that is the value. But I think when you have people changing their name and you have new coins popping up every day, and you read their white papers and they're not really saying anything, there's really no product, there's no service there, it's scary. It's a scary space.
I want to roll back for a minute and ask you about, you talked about how do you assess the value, and that you said that's a lot of stuff that you talk about in your classes.
Oh yeah. Yeah.
So obviously today we're investing in the technology of the future.
Mm-hmm.
There's no earnings to put them against. But even with stocks that have earnings, like Apple, for example, right? The market's at an all-time high, 25,000 or whatever. So even a company like Apple or whatever, Amazon or Microsoft, whatever, why are they 20 times today when they used to be 8 times?
Very
Like,
good. Excellent question.
you know what I mean? Like, why is the value now more than it was before? I mean, their earnings went up, but I mean,
But not 20. Right, right. No, I get you. And that's a very, that's a loaded question. Great question. But I think we have a number of things in play. And to understand our markets, you have, and this is the point I was trying to make earlier, Mark, to understand our markets or any market, you need to understand all the variables in play. So if you look at the stock market, you have this current administration and people's exuberance around, tax law changes, which again, we don't know. We don't know, right? You have the Fed. I mean, I think the primary driver of our equity markets started a while back when the Fed
started in
started.
1970 when we got off the gold standard.
Well, I mean, yeah, we can go back there. We can go back a little further than that. But yeah, I'm with you there. I understand the history of our currency very well. But I mean, if we want to isolate it, we can say when they started easing and the world was hungry, for return. So where are they going? You have to up your risk. And this is what is driving a lot of what's going on in these equity markets.
I'd be curious to talk about that piece right there, because I'm glad that you brought that up. So really, the monetary policy has really kind of fueled a lot of these bubbles that we've had.
Absolutely.
That's what you're saying. So, I mean, it fueled the tech stock boom in the 90s. It definitely fueled the real estate boom. I mean, basically, for those that are watching that don't know, the banks are basically giving money away for free in a sense, in very simplistic terms, which people then pushes the interest rates down. So people are chasing returns. They're getting money for basically free and putting it everywhere. So then when you get money for free, you put it everywhere and it pushes the prices up. I mean,
well, let me step in there and adjust that a little. So you pulled up that chart with debt. I mean, I think that's very telling. The debt on not only personal, but at the institutional and governmental level, debt levels are at their highest ever.
Right.
I mean, that in and of itself, we can put a period there, Mark and Charles.
I agree.
Stop right there. That is scary. And
I would be on that.
So let's talk about monetary policy very quickly, because we could do this for hours, right? What is the Fed doing? What is the central bank doing when they come in and ease markets or try to stimulate a market? Well, what they have the power to do is create treasuries. We know treasuries are debt that is created by the US federal government. So they sell these treasuries to you, to me, and primarily to governments across the world. China has historically been one of the largest purchasers of treasury securities. So when you sell or you buy, you're either putting money in the market or you're taking money from the market, right? So when they put money in the market, right, when they start selling treasuries, they're receiving money, right? Or when they buy treasuries, they're putting money in the market. So what they're doing is they're going and they're buying treasuries. So if they're buying treasuries from the market, and in exchange for buying that physical asset, that physical security, they're increasing the money supply. And when you increase the money supply, all things constant, that puts downward pressure on interest rates. And I use this example in class. If I'm the only one with $1,000 and 50 people want to borrow my $1,000, then what am I going to say? I'm going to start raising interest rate. Well, how much are you really willing to give me for this $1,000, since all of you, the demand is higher than supply? So to flip that, right, they say, well, let's put a whole bunch of money in the market, right? Let's increase the money supply. And that should, relative to demand, put down, as Mark said, put downward pressure on interest rates. And what do we hope? We hope that as interest rates go down, people start to consume more. I use this example in class. I say, how many of you in here are interested in buying a car? We're talking college students, right? Maybe one person will raise their hand. I said, well, what if interest rates are 22%? How many of you are now interested in buying a car? Everybody's hand goes down, right? I said, well, what if I'm giving you money for free? 5-year loan, 0% interest. How many of you would think, and all you have to do is pay me back my interest over the next 5 years? Half the hands in the class now go up. So interest rates impact our consumption behavior, and the market understands this. The Fed understands this. So they go in and they ease the market. But what they're doing is they're flooding the market, right? They're either now the balance sheet of the Fed is pretty large, and they have to figure out now how to unroll all of these treasuries they've purchased, right? So they've purchased. Interest rates are low. And now you have all these people sitting on this cash, and they're like, but we need some yield, we need return. So what are they doing? They're flooding to the equity markets.
Right.
They're jumping into the equity markets, buying securities without, right? Because what's the alternative? To go abroad? I mean, the international markets are, in many cases, are worse off than us. So we're the sunshine in the cloudy day. So that's why our markets are higher. It's irrational, and we see this now that everybody's looking for, people are looking for anything that is giving return. That's why cryptocurrency is. I mean, I have 8-year-old boys, and they're like, "Mom, let's talk about Bitcoin." And I guess they overhear me on all these talks. But everybody knows what Bitcoin is, even little kids. Yeah. Why? Because there is this machine, and people are looking for return. And right now, crypto is giving it. But it's a scary thing when you have money flooding somewhere without understanding the vehicles that are in place. And once those vehicles pull back, what does that do to the equity markets? What does that do to crypto?
So what I wanted to do by bringing this up is I wanted to point this towards a trend that we've seen, how every market inflates higher because of these policies.
Mm-hmm.
So, the tech stock bubble was here, the real estate bubble was here. The auto program, like you said, actually the auto loan debt was one of our biggest bubbles we're sitting on right now.
Yeah.
Like 70% of all auto loans are subprime right now. So that's a massive, massive bubble. I mean, trillions of dollars just in auto debt that's subprime right now. So that's a big problem. But that's not my point. My point is that these policies, they keep it puts all this money into the market and has to go somewhere. So every bubble gets bigger than the last. So my point that I wanted to kind of move towards was, what does that mean for this market, right? If the tech stock bubble was a U.S. focused area that went up to 3 trillion. Now we have a global market, and with a global debt, and we understand that each bubble is bigger and faster than the last because of all this loose money sloshing around in the system.
Exactly.
I believe, and so I just for the sake of conversation, so what does that mean, right? So like, if we saw 3 trillion over 5 years in this tech stock bubble, does that mean 7 to 12 trillion in a year and a half? I mean, hypothetically,
Yeah.
I mean, but before you answer that, I know numbers and times are super hard, and I don't want to put that, but would you agree that because of these monetary policies sloshing around and each bubble getting bigger and faster, that we might see this one be bigger and faster than the last one?
Yeah, again, I don't know. And I totally understand your question. I think what you're speaking to, though, Mark, is exactly why regulators are looking at this space, right? So they're like, listen, if this is a global phenomenon, like you said, the majority of the trading, and you know this institutional details better than I'm sure, but this is a global space where the majority of the trading is happening abroad. What happens when we have another global crisis? I mean, what happens when people start calling in this debt? I mean, that is just, the debt situation across the world is really freaking scary. I mean,
it's the problem. That's
the problem. And nobody's talking about it. I mean, the leverage. I mean, listen,
it's like drugs. The world's addicted to it.
Right.
They've got themselves in a situation now. They can't get off the drugs. They can't get off the debt because
how do you unwind this debt? Exactly. Listen, I am aware of teenagers that are informed in this space that are trading on margin 20% multiples. I'm not 20%, 20-time multiples, and that should not be. It really just should not be, because when this thing implodes, and we've seen this before, there is going to be a massive amount of money and capital just wiped off the face. And the question the government has to ask is, can the market absorb another massive blow without losing all confidence in the markets? And everybody loses then. You lose, I lose, Charles loses, everybody loses, because I have assets all across the market. I mean, I have real estate, you have real estate. So that's why they're looking at this space. And that's why I expect regulation to come fast and pretty furious. So we'll start to see, what do we see? What will we start to see when regulation comes down the pipe? We'll start to see circuit breakers. you know, where if returns swing greater or go up or go down within a certain bandwidth, outside of these bandwidths, they'll halt trading. Right.
So you talked about confidence. This whole system is built on confidence, and this is another hole we could jump down. But how the banks are, it's a fractional reserve system.
That's
and
right.
So the banks don't have your money.
Right.
And if less than 1% of people went to the bank and said, you know what, I'm scared if this global thing goes down, I may not be able to get my money. Let me just get my cash now.
Right.
Less than 1% of the people did that, it would crash the system. So do you think they're scared about 1% of people moving into crypto, which is essentially the same thing?
I believe they are.
I mean, if I say, you know what, I'm just going to put my money in crypto, I mean, 2-3% of the people in the world do that. That's essentially 1% of the people taking their money out of the banks. And then what happens to the banking system?
Listen, I think it's less, you know, if we study human behavior, I think it's less about, I think regulators are trying to get ahead of the ball game, right? So even before we talk about, you know, whether there could be a massive transfer of wealth from the stock market to crypto, first of all, I don't think that will happen. I think the blockchain, I think they'll once this market becomes more developed, and I think the only way that's going to happen is really through regulation. I guess that's the point I'm trying to make. The only way that this market will be able to become more mainstream is if it gets regulated. So I just think people need to understand that, and then understand what comes along with regulation. What's going to come along with regulation won't be these, you know, 2,000, 3,000% returns in a 6-month period. That's going to go away. I liken this to this, Mark. You know how, you know, people watch these crime shows, and you know, you name them. There's one on every night, sometimes back to back. Now everybody thinks, you know, something happens to a loved one. Heaven forbid, Lord, I hate to be so grim, but you know, like, why haven't they solved it yet? You know, this is the new. You're supposed to. TV told me that you're supposed to be able to figure out who the bad guy is in about an hour and 15 minutes, right? So, you know, this is transforming people's thought process. It's becoming the new benchmark, right? Well, the government's not that. It's not reality. It's not reality. So here's the point I'm trying to make, because my mind is going 50 miles an hour, 5,000 miles an hour in this space. If you believe that regulation is not coming fast, I think you are misguided. 1, 2, if that and when that happens, I think it would be naive to believe that the returns that we have seen will persist. And I think if you can just absorb that and swallow that.
Let's stop on that point for a second.
Yeah, sure.
So, yes, I agree 100%. And it's something that Charles and I talk about all the time. And it really, I don't want to say it makes me mad, but I get concerned when I hear these people coming in and they think it's like this crystal ball, or not a crystal ball, but like this money machine where,
right.
You know, I have people who, you know, they haven't seen it go up much in 5 months. You know, I had people tell me, oh, Ethereum's boring. I only got up Ethereum. It hasn't done anything in a couple months. I'm like, it's gone up 5,000% this year. What are you talking about? But because it didn't do anything in a couple months, I can't believe that. And I've been investing for over a decade. So yeah. I understand 10% a year, 12% a year is really good. But I do agree actually that regulation is coming fast and furious. And as a matter of fact, in my 2018 predictions, I said that's going to be the big theme this year is regulations. So we're definitely going to see that. There's just no way around it. The point thing I would say is I do agree that these types of returns are abnormal. Mm-hmm. They're not to be expected, but I don't agree that they're going to go away. And here's why. $1,000 in Uber 3 years ago is worth 20 million today.
Okay.
And Uber, I mean, that industry has been regulated for 20 years. Instagram, same thing. So you still have those unicorns that pop up. I mean, it's like the lottery. Don't get me wrong. It's not normal. But if you're in those VC crowds, you are seeing those types of returns because it is a new technology still. So I believe we're still at the beginning stages of this technology, and we're still going to find those returns, but it will definitely not be normal.
Right. And so, yeah, no. And I get you there. I think you said two things that I think are really important. You said, listen, it burns you up when you see people say, gosh, I've only received 600% in 2 months. And this one is 12, Mark, what does that underscore? It underscores how many people in this space that aren't like you, that don't understand how markets work. Like they're not quite with reality. And when you have those type of players in any market, the market is skewed, period. Now, to what degree the skew actually exists, I don't know. Again, I'm not a trader in this space. I am an observer. I'm a market participant, but in another way, on the regulations side of things. So that's what's sort of scary to me. And then the last point I'll make is, as you stated, there are those unicorns that exist. But when you see people that don't understand this whole industry and they're jumping in for any ICO is pretty much doing well, whether it's BS or not. That's sort of scary. So it's creating a lot of wealth.
Just to add, even the BS ICOs are doing well.
That's what I'm saying. Any ICO is performing.
No, like even the ones like, I don't know, have you heard of Useless Ethereum token?
I have not.
You should check it out. But like Useless Ethereum token.
That is hilarious.
Their whole, actually, let me pull this up on the screen. It's pretty funny.
Hey, I appreciate the transparency in their name.
Well, their marketing is 100% what makes them unique. In addition to their token bonus, which is a really good deal. Let me pull up Useless Ethereum token.
Sure.
Hold on, Useless. I'm gonna pull it up real quick on my screen before I share it, because once I share, my Zoom slows everything down.
Yeah.
Check this out.
But I'll just say, go ahead.
You'll love this. Useless Ethereum token is the world's first 100% honest Ethereum ICO. If you're going to give some random person on the internet money and they're going to take it and buy stuff with it, probably something like electronics.
That is hilarious.
And then they say, seriously, don't buy these tokens. So
that's hilarious.
If you look at it, it's a first of the kind ICO, This ICO is different because we offer you no investor value.
Wow, they're up to 400,000?
Yeah, they have now raised $400,000.
Listen, I'm going to have to write this down because I've got to use this in class. Listen, they have the middle finger up. Listen, that's their symbol, a middle finger. Like, I love it. No, but listen, to Mark's point, that this is hilarious. But to Mark's point, Mark, I think you're quite correct. And the way we started this conversation is really important. A lot of these companies are going to fail, but some will persist because they have something real. And they're honest about that real thing. And those that can find those unicorns and stay with it, you're right. There are significant returns to be had because I do believe this technology is a game changer.
I think it's really hard to discuss these topics without getting into some sort of like politics, and I don't want to do that. But I was just curious, and we're kind of running out of time. But
yeah.
I could go on these questions forever. I'd love to get in the perspective. But you talked about the monetary policies and how these Wall Street investors or whatever, they're looking for yield anywhere, right? And so they're throwing money everywhere looking for yield. And then that because there's so much money, it pushes the yield down, and it's kind of a snowball. But with the way the regulations are, the way the SEC is right now, well, before I say that, so that the institutions have all this money and they're looking for yield and they're putting it anywhere they can. But do you think that the average public also realizes that their wages have gone down, their money doesn't buy as much as it used to, and that if they don't invest, they're never going to get ahead either? And they're stuck getting 0.00001 from their bank, and the average person needs some sort of a yield as well. And they realize that Wall Street isn't really giving it to them, but a lot of the good money is made in these VC things, and the SEC prohibits them from being involved in it.
Well,
And maybe they're looking for an avenue just like the institutions are looking for an avenue.
well, the institutions are making money regardless of what market they're in. You know, when the market is up, institutions are making money. When the markets are down, the institutions themselves are making money. Who loses? I think you're right. I think it's the everyday, we call Main Street versus Wall Street. Main Street generally loses, right? Because we tend to not be informed. But I think I would just jump in and say that the market has done well. So again, we're not talking about, 4,000% returns, of course.
Right, but like the average person's not allowed to invest in Uber or Instagram or Airbnb, before they hit the market. That's
but you don't have to be invested in something giving you 1,000% to do well. I mean, if you were in the stock market, again, and I'm not a proponent of one way or the other. I mean, I like real estate. I like things I can see and touch and understand, and that. Anyway, I'm in the stock market, of course, as well. But I mean, if you were in the stock market this past year, I mean, you killed it. I mean, you did well. I don't remember the number. I think the market was up
35%.
Yeah, something like that. So my concern in this space is that as I look at a lot of these blogs and these information feeds, I see people taking really risky bets in an industry that I think they shouldn't. Now, someone like you, Mark, I mean, I'm making an assumption. I assume you have a few pennies in the bank. Someone like Charles, someone like me, going in, putting 10, 20, 30, whatever, putting X amount of dollars in this space means something altogether different than someone who doesn't have money if a tire blows. Okay, doesn't have anything or not very much in a 401k when their employer is matching dollar for dollar. I mean, that is matching dollar for dollar. That doesn't understand some of the basic concepts and proven concepts around investing, and they're jumping and putting their paycheck. I mean, some of the stuff I read, I have to shut it down because it's scary.
I agree. Yeah.
So, I mean, again, Mark, I believe in the technology. I agree. I mean, we're on the same page in I think in most respects, respects. The technology, I think, is going to transform the way we do a lot of things. And I think if you're investing in the technology, I think it's smart to do so. I think a lot of these coins, as Charles has just shown, are BS. They're BS. And people are not informed enough to invest in the right thing. So if you can get behind an information vehicle that is giving you true information around what's what in the space, I think it's a great investment to do so. Okay, to make sure you understand what you're doing in this space, as is the case with any market. But I'm careful to shift the bar for returns to something that's not sustainable. And I think, just like you said, Mark, it burns you up when you see people saying, well, the Ethereum or XYZ coin is boring. Something else is giving me this. I need to jump in. This is a dangerous game. This is a dangerous game because it's not sustainable. It's not sustainable.
Yeah, I agree.
That's my opinion.
I agree.
I think we're all in agreement that there is a short-term window for an asymmetric return.
Yeah.
And, the key of navigating this is, there's going to be a bubble. It's going to pop at some point. And if you are not sophisticated and if you don't understand and if you don't have the tools and stuff like that, and if, you believe that Dogecoin actually has a future, despite the fact that, it's worse than useless Ethereum token and it has $1 billion plus market cap or coin market cap right now, you're probably going to get wiped out, and it may not be today, maybe it'll be tomorrow, and things like that. And another thing is, right, the less sophisticated non-professional investor is emotional, right?
Very emotional.
If you don't have the tools, the training,
that's right,
abilities, and also the ability to be unemotional so that when Ripple's blowing up, realizing that, wow, just because Ripple's gone from 20 cents to $2, that's probably tells you shouldn't be investing in it anymore because the rocket's going on. And if you catch the rocket at the $2 level or the $4 level or whatever, it's probably going to come the other way because that's just how markets are.
Mm-hmm.
You know, like that's that level of, you know, the emotional investor. They might get lucky and ride one, but they'll hold on it. So they'll ride it up and then they'll ride it back down.
Mm-hmm.
And, you know, when all said and done, they won't have much to show for it.
It's called the disposition effect, and it's very real. It's very real. I mean, if this whole behavioral finance area is actually fairly new because we've believed for so long that markets are rational. We believed in what's called the market markets are efficient, and they are efficient as long as the agents within that market are rational. Well, what do we know? We know that is just not the case. So if you don't understand human behavior, and those that do make a lot of money. I mean, think about how marketing works, period. Marketing is a vehicle in and of itself because those people understand what makes people pull the trigger on a purchase, period.
Sure.
That's why marketers make money. They make a lot of money. So it takes all of these agents working together. And there's a huge marketing machine right now in place for around crypto. I mean, you can't go to Yahoo Finance. You can't go to any mainstream press, MSNBC, Bloomberg News, and not have out of 20 articles, about 40% of them not pertain to crypto. I mean, everyone's talking about it. So it's feeding a frenzy that I'm just concerned will wipe out capital for people who can least afford to have that capital wiped out because they're doing this catch-up thing, this catch-up syndrome, as I'm calling it, right? Well, I missed that boat and I missed Tuesday's boat. I'm not missing this boat, damn it. I'm going to jump in and I'm going to jump in hard. So these people aren't like you, right? Who may have money you're sitting on and it's going to wipe them out. And I think regulators are concerned about that. Then what? Who do we then have to turn? Who do we then have to bail out? Who will be bailing out when people can't retire because they, put their money in crypto and they put it in useless. What did you call it? Useless. They put it in useless.
Useless Ethereum,
they have
useless Ethereum token.
Not only have a symbol that has a middle finger up. They say don't invest in it. They say this is BS, and they have raised $410,000. I mean, if that is not, I mean, we can end that thing right there, Charles. We can end right there.
Yeah, no, I think it's time to wrap up. It's great. I think
right.
We started this. We were all feeling under the weather, thinking, oh my gosh, let's be on for 15 minutes and call it. And we're at an hour now. I think we keep going for a couple hours, but we all have to go. So
Mark needs to rest. And sunny Hawaii, I hear. Not fair, Mark. So not fair.
I wish I could enjoy it a little bit more. It's actually still dark over here.
Okay.
It's early, but
okay.
It's early. So hey, guys,
I'll nurse myself back to health. Try and get a little sun.
Good for you.
Good problem to have. So guys, everyone out there, thank you for tuning in. Again, we had myself, we had Mark Moss, and we had Dr. V. Hopefully Dr. V enjoyed herself enough that maybe this might become a more regular occurrence with her hopping in. So, we'll keep our fingers crossed on that one.
Thanks for inviting me. I'd love to be back. No problem at all, Charles. Anytime.
All righty. Okay.
Thanks, Mark. Get better, buddy.
All righty. Well, take it easy. Thanks a lot, guys.
All right. Have a great day. Bye-bye.
Okay. Bye-bye.